The current downturn in the market has many afraid that we may be entering a crypto winter. Today we're going to discuss this possibility, take a look at prior cycles, and see where the market is headed. Hey guys, Sheldon Evans here, welcome back, or if you're new here, don't forget to hit the subscribe button and turn on all of those bell notifications. If you find any of the content in this video useful, please give the video a thumbs up too. Now, from my display, you can clearly see that we are still within a sea of red across the market. Negatives line the screen. Now, of course, due to this, we are having a major downtrend, almost at this moment around 45% down from the all-time highs of Bitcoin, and at the lows around 50% down from the all-time highs. So we did come back down and grab that liquidity region that I've mentioned many times on this channel for many months, back from when we did have that initial crash back in May in 2021. Now, this could be the potential marking of a new bottom, but in the event that it is not, what does an extended bear market, or what we would describe as a crypto winter, look like? An extended market or an extended bear market of 1 year plus, where we either trend sideways or down and to the right over more than a year's time. First, we need to take a look at what caused this initial crypto winter back in 2017 and prior cycles to try and determine what the future looks like for crypto. Now, what initially caused this downturn in the market back in 2017? Of course, it was institutional investors, or at least large hands, taking profit while still drumming up hype for the public and retail investors to sell their bags to them. And you can see this from this chart by the number of addresses with a balance greater than 1,000 Bitcoin. You can see that back in 2017, while institutional investors were dumping their bags and decreasing their Bitcoin balance, we made new all-time highs in Bitcoin. And this essentially means that the public was buying the Bitcoin away from the institutional or the larger handed holders. And the same thing happened this time around, where we saw a rapid decline in balances greater than 1,000 Bitcoin, while still making slightly newer highs on the Bitcoin chart. Of course, not quite as dramatic as 2017, but we did still make somewhat of a newer high in Bitcoin as we had that sort of rounded peak over to the top. So not quite a blow off top, but more a rounded peak and a slower decline to the top. And this could, of course, be due to either higher investment amounts, larger market caps, and larger amounts of capital required to move those market caps. So we have this sort of slower rounded top compared to 2017, when the market cap was much smaller and it was easier to move this amount of capital and move the price of Bitcoin at a faster rate. Now, does this mean that we're about to enter an extended bear market? No, not necessarily. You can see that the institutional investors have taken their profits, and we've sort of reached this plateau where we aren't necessarily getting new addresses and we aren't getting any less addresses with greater than 1,000 Bitcoin. But the market is entirely different this time around. The entire market structure, the type of investor, and we have institutional players in the game this time around. And the first thing that I'm going to use to outline this is, of course, DeFi Llama with TVL, the amount of total value locked in different networks. Now, if we look back at 2017 and prior cycles, we didn't have all of the coins and projects and networks that we do have today. Of course, we had the ICO boom and shitcoins were booming left and right, and new projects were popping up and people were throwing their capital into those projects. But they weren't long-term sustainable projects. Of course, some of them were, but many of them died and went to zero. And we didn't have lockable capital. So for example, back just in September of 2021, or of 2020, we had about $10 billion or $8 billion locked in total value. Now, at this point in time, we have around $190 billion TVL. Back in November last year, we had around $250 billion TVL. Now, this is money or capital locked within these protocols, obviously either working towards this securing of those protocols or trying to earn money, earn yield, and secure these protocols. An example of this is, of course, Ethereum. With Ethereum 2.0 coming out, people can lock up their Ethereum into the ETH 2.0 contract with the hopes of potentially validating and securing the network in the future on the consensus layer. This happens across many chains. Of course, we have Luna, we have Cardano, we have Avalanche, we have Polkadot, all of these chains that you can lock up your capital and earn yield and earn staking rewards on. Now, this is an incentive for people to not remove their capital, to remove their assets from the market. This is because they're earning capital, they're earning interest on staking their coins. So it is in their best interest to keep their capital, to keep their assets locked up in these protocols, because over time their assets grow, not just in the US dollar value terms, but also in the staking size or the actual holdings of those coins. Now, we didn't have any of this back in 2017, so people were very, very quick to sell their coins when the market was in a downturn and panic sell on a moment's notice, of course, trying to run one another. This time around, we obviously have staking, and we have undelegation periods for many of the coins as well, meaning that you can't unstake immediately and sell on the market. You have to wait a certain amount of time before you have access to those tokens again, because it is you who is securing the network and helping the network's function and the protocols function properly by securing and locking up your capital. So it is in our interest to have capital locked in the market, because it does provide some sort of a potential downside limit. Now, of course, $200 billion locked out of a $2 trillion plus market cap of the entire crypto market doesn't necessarily mean that we have a lot of downside protection, but there is some. Around $1.7 trillion here, with around $190 billion. Many people are saying, of course, if all the capital is locked in TVL, this capital is locked in these protocols, the market can't go down. Of course, that is entirely incorrect. Do not listen to anyone who says that. We do have some downside protection, but not nearly as much as some people believe. But it is a contributing factor to how different the market is this time round. And I've mentioned in previous videos that because we have these protocols that allow you to lock up your assets and earn interest on them, we may potentially see an even increase in this during markets of volatility or markets of extended downturn. And the reason being is people are looking for other ways to earn capital or increase their bags during periods when the market isn't booming. So they look to TVL and look to products where they can stake their assets in order to earn that interest. We can also take a look at the cumulative value of assets under management of crypto funds worldwide. Back in 2018, we had around $5,800 million or $5.8 billion locked in funds. Now we have around $59 billion locked in funds, an entirely 10x gain in capital locked up in crypto funds. And this is only increasing with time. Of course, as regulation comes around, as new funds start proposing new products and so on, we'll have bigger and more institutional investors coming into the space and investing in throughout these funds. And I've mentioned in the past that institutional investors are more likely to invest through a fund or through an ETF or something like that, rather than a simple straight self-custody method like you and I, the retail investor, do by buying our coins on an exchange and holding them on a hardware wallet. This is a huge risk for institutional investors and large players in the space, because that is a single point of failure. So they are looking for external custody solutions, and the easiest way to get access to the crypto market is, of course, through a fund. Now, for the crypto purists and crypto maximalists, the core technology around blockchain is, of course, decentralization and self-custody. But if you want to make money, which most people are looking to do in this market, most people are investors, not necessarily here for the tech. As much as you may say that, you might know to yourself that it is entirely bullshit. You're here to make money. And once people are honest with that and they understand that most people in the space are here to try and make quick gains, they realize that they don't care about the decentralization. They don't care about the tech behind crypto. All they care about is number go up. And the easiest way to do that is by getting access or getting allocation to this market, and whether that's through the native asset or through some sort of fund or derivative asset. Either way, whoever can get access to whatever they can, wherever they are in the world, is what they will do, because it means they can increase their capital and increase their wealth. So over time, we will see more and more of these funds start forming and coming up. As regulation gets eased off or gets more clarity around regulation, we'll see more of these start forming as well, and even larger institutional players coming into the space. We also have major companies like Google Cloud ramping up its blockchain efforts by launching a digital assets team. So Google is launching a new dedicated digital asset team to help underpin the blockchain ecosystems of tomorrow. Whether you're implementing blockchain strategies or blockchain native, you can rely on our scalable, secure, and sustainable infrastructure. So we have these major corporations also looking to get into blockchain and to get into the crypto world. We've seen this with Meta, we've seen this with Square, we've seen this basically with Facebook and Twitter. They're all looking to get into the world of blockchain and into NFTs because they see not only a monetary gain or monetary opportunity here, but also because they do believe in the future of the technology. And we'll see this happening more and more frequently as, of course, we get more regulation or more clarity around regulation, and we start seeing more capital come into the space, because everybody wants a piece of the pie. Whether they say it or not, everybody is looking for a way to capitalize on this new industry and trying to solidify themselves as the king of blockchain or king of the metaverse or king of the NFTs, whatever you want to call it. These are all things, or all these institutions are coming into the space because they know this and they want to underpin themselves as the king of these spaces. So We, of course, have Google doing this. We have YouTube head of gaming, Ryan Wyatt, to resign and join Polygon Studios as CEO. So we have gaming, of course, one of the biggest industries in the world right now, esports and so on, coming into the NFT space. Of course, a lot of gamers and a lot of people don't quite understand NFTs and why they form such an important part of our future as cryptocurrency. And I saw a tweet earlier today saying that NFTs were essentially the super cycle, not crypto. And in previous videos, I've said that NFTs are the sort of Trojan horse that brings cryptocurrency to the masses, because you don't quite need cryptocurrency to get access to NFTs. And in the future, it'll be even easier, where we have Coinbase and MasterCard and Visa partnering and so on to sort of mitigate this gap, or bridge this gap between getting crypto and then getting access to NFTs, but simply going straight from the traditional fiat world into NFTs. And then once they're in this world of NFTs, they then own NFTs that are on the blockchain, and to sell them and liquidate them, it would be easier to do that through cryptocurrency, therefore bringing more money or more capital into the cryptocurrency ecosystem. So we see this world of gaming merging with NFTs as well, and we'll see an even increased attention around NFTs and cryptocurrency with that. So once these major companies and so on really start developing in the space and aren't just sort of exploring like we're seeing at this stage, or sort of setting up shop and trying to figure out and play and break things, once we start seeing solidified solutions and so on being built in the space by major corporations, even though people don't want corporations in the space and they're saying that it's ruining the future of decentralization and so on, I think it's very good for the space because it does bring some legitimacy to it. People do trust corporations to some extent, because if you see somebody using an iPhone, you know that it's a good product. If you see somebody using Google, you know that it's a massive corporation and you won't really go wrong with it. Even though they are these corporations and they do things wrong, not everybody's going to be completely satisfied and happy with what they do, and not everything's going to be fair. It does bring a lot of eyes and a lot of attention to whatever they touch. And in this case, it's going to be cryptocurrency and NFTs, a very, very fortunate part of the future of crypto. Now, an unpopular opinion here is that new money cares more about NFTs and GameFi more than DeFi tokens. It doesn't help that the new DeFi protocols are getting more and more complex. This is just what I mentioned, that most new capital coming into the space is looking at NFTs. I've seen this many, many times, especially speaking with people on the street and people that I interact with on a daily basis. Many people know what NFTs are, but they don't quite understand how they link with cryptocurrency or even what crypto is. They just see expensive JPEGs on the internet and they have their friends talking about it, but they don't quite understand anything more than that. And if you are watching this video and you don't understand NFTs and you still think it's a scam, please understand that NFTs as art in their current form is not how it's going to be in the future. It's not the optimal use of the tech. NFT is just the tech behind the JPEG. There's just an image attached to a piece of code, attached to a contract, attached to a verifiable piece of code that you can own and then you can prove ownership of. The NFT in its current form as an image that has value is just the use case that seems to have taken off quite rapidly. But please understand that if you are still calling NFTs a scam, you don't quite understand the tech behind it and how important the technology of NFTs actually is. NFT is a non-fungible token, not non-fungible image. It's got nothing to do with images. That is just the current use case, how it's been implemented on a mass scale. Of course, this will develop over time to many, many different industries, and we'll have verifiable contracts across industries. Speaking of NFTs, of course, Nostalgia by YMH, my NFT collection, currently at a 3.2 ETH floor. It was up to around a 4 ETH floor earlier today. That's a 400% gain from our minting price. Of course, these are not just pieces of art, as I've just mentioned. They do rely a lot on the technology behind NFTs. They function as an access token, meaning once you purchase one of these, you get access to private channels in the Discord where we can talk about a bunch of stuff around NFTs, around crypto, and obviously you get opportunities and access with that. You get access to 2 more NFT mints that you're able to mint using this token. You're able to get whitelist opportunities and Discord invites to other communities that are launching and other projects that are launching. So there's a lot of utility behind this token. Ignore the art. Perhaps you can speculate on it if you like. Perhaps you like the bear more than the water pistol, more than the juice box. That is completely irrelevant. These images attached to these utility tokens are arbitrary. What you really want is the utility behind the token. So please understand that if you are looking to get into NFTs, that utility is key here. And finally, I want to talk about ETH2 is no more after Ethereum Foundation ditches the name in a rebrand. So many people missed that Ethereum 2.0 rebranded and changed its name to more so the consensus layer to try and make it a little bit easier for people to understand, although this is a piece of news that doesn't really make sense at this point because ETH2 is widely accepted. But in order for people to perhaps going forward understand what ETH 2.0 is in a better or easier way, Ethereum 2.0 is not something completely different to Ethereum in its current form, except an upgrade from a proof of work system to a proof of stake system, meaning that the way the network is validated, the way the transactions are validated goes from a mining incentive program to a staking incentive program. So, I mentioned staking earlier in this video where people are locking up their coins to secure the network. Many projects at this stage are proof of stake. Ethereum is transitioning to that, and it will have two layers. It will have the base layer, which is the execution layer, which is the current Ethereum layer, and then we'll have the consensus layer, which is Ethereum 2.0. Now, one of the major problems with the ETH2 branding is that it creates a broken mental model. Of course, that's what I've just said. Everybody in the media already knows ETH 2.0, but they're doing this to try and stop many of the scams. When ETH 2.0 really does finally roll out, you don't have to swap any of your tokens. It will be automatically converted. You don't have to fall into any of these traps of people trying to sell you their ETH 2.0 tokens. But one of the major things that's going to happen, I think, in 2022, if this does end up happening, of course, we have many delays from the Ethereum Foundation, and with good reason. We do want a final good product from Ethereum and from any project for that matter. Delays are essential, in my opinion, to the roadmap. You don't want to release a half done project. You want something that is perfect at the end to avoid maximum pain. So once ETH 2.0 does come out, I do believe that we will potentially see some sort of a market drop. Of course, that releases a lot of the Ethereum 2.0 already staked in that contract. So this could be perhaps the next breaking point or the next catalyst for the market. But over time, I think the market will eventually recover. The market, as I've just outlined, is very different to prior cycles. The current structure of the market, the TVL in the market, and the way people interact with the market, earning yield and playing on DeFi protocols and trading NFTs and so on, has a much more of a sustainable model than people simply throwing money at random ICOs and trying to capitalize on that and then exit the market in a hurry. Instead, this time around, we have people locking up their capital and locking it for long-term wealth, long-term storage, and long-term accessibility and functionality within those protocols. I think this market is entirely different this time around. And while we might see some sort of an extended downside or perhaps many months of consolidation, as I mentioned in previous videos, we have essentially been in consolidation for just over a year since we're at the same prices we were at 400 days ago. This is sort of a consolidation period that we've been in for a year. Now we might see something very similar to this for the coming months or coming years, and a slow and steady grind up and to the right or sideways for an extended period of time. But of course, this major downtrend that we've had over the past little while isn't necessarily isolated to crypto. It is, of course, like I've mentioned, very much across the market. The everything bubble, as many people are calling it, is popping, and we are seeing downturn not just traditional stocks, but also in tech stocks and so on, as we saw a major crash recently in recent weeks. And this is trickling over into the world of cryptocurrency. But if everything does hold and potentially the world doesn't collapse and go into an utter hell, I do believe that cryptocurrency will survive, and over time we will have a slow and steady grind up and to the right. I hope you guys liked that video. If you did like the video, please don't forget to hit the subscribe button, turn on all of those bell notifications, and give the video a like if you found anything in this video useful. If you made it all the way to the end of this video, please comment down below. Purple monkey. Bye-bye.